Known as the father of value investing, Graham's insights have shaped investment strategies of countless investors, including Warren Buffett. Let's explore how you can apply these timeless principles too. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. Benjamin Graham, a legendary economist and professional investor, wrote The Intelligent Investor to teach average people the principles of sound investing. His philosophy centers around value investing, buying stocks that appear undervalued by the market. Graham emphasizes the importance of investing with a margin of safety and viewing stocks as ownership in real businesses rather than speculative instruments. The essence of value investing is to look for stocks that the market has undervalued, focusing on companies with strong fundamentals and a margin of safety to protect against losses. By treating stocks as businesses, investors are encouraged to think long-term and focus on intrinsic value rather than short-term market fluctuations. To implement these principles, start by understanding that investing is about acquiring a piece of a business. Before buying a stock, ask yourself if you'd be comfortable owning the entire company at that price. Focus on a company's intrinsic value and ensure there is a margin of safety, meaning the stock is priced below its true worth to provide a buffer against unforeseen market conditions. In the first chapter, Graham defines the difference between investing and speculation. Investing is about thorough analysis, ensuring the safety of principal, and expecting an adequate return. Speculation, on the other hand, involves taking higher risks for potential quick gains. Graham warns against speculative activities and stresses that intelligent investors should aim for long-term growth rather than quick profits. He emphasizes that speculation can be dangerous if not distinguished from proper investing, as it often involves betting on market fluctuations without considering the underlying value of the asset. To apply this lesson, set clear investment goals and develop a strategy focused on long-term growth. Avoid the temptation to chase trends or time the market. Instead, base decisions on thorough research and analysis, ensuring that your investments align with your financial objectives and risk tolerance. By the way, if you want to read the full book, there is a link to it in the description below. Graham discusses the impact of inflation on investments and advises investors to focus on real returns adjusted for inflation. He highlights that over long periods, inflation can erode purchasing power and suggests that a well-diversified portfolio, including stocks and bonds, can help mitigate inflation risks. Graham notes that while cash and bonds are safe in terms of principal, they may not keep up with inflation over time. To implement this advice, consider allocating a portion of your portfolio to assets that typically perform well during inflation, such as stocks, real estate, or inflation-protected securities. Tips: focus on achieving real returns that outpace inflation to preserve and grow your wealth over the long term. This chapter provides a historical perspective on stock market returns. Graham illustrates how the market has evolved over the years and emphasizes the importance of having realistic expectations. He notes that while markets can be volatile in the short term, they tend to trend upwards over the long term. Understanding historical trends helps investors set realistic expectations for future returns and avoid being swayed by short-term market movements. To implement this knowledge, study historical market trends and cycles to develop a realistic understanding of potential returns and risks. Use this knowledge to maintain a long-term perspective, even during market downturns. Remember that short-term volatility is normal and that the stock market has historically rewarded patient investors over time. Graham introduces the concept of the defensive investor, who prioritizes capital preservation and steady growth. He advises a balanced approach, typically a 50-50 allocation between stocks and bonds, depending on market conditions. The goal is to minimize risk while still achieving reasonable returns. Defensive investors should focus on well-established companies with a history of stable earnings and dividends. To apply this strategy, evaluate your risk tolerance and financial goals to determine a suitable asset allocation. Consider rebalancing your portfolio periodically to maintain your desired balance between stocks and bonds. This approach helps reduce risk and provides a stable foundation for your investments. In this chapter, Graham advises defensive investors to invest in large, well-established companies with a history of stable earnings. He emphasizes the importance of diversification to reduce risk and recommends avoiding high-risk stocks or those with high valuations. Defensive investors should seek companies with strong financials, a history of dividend payments, and a consistent track record of performance. To implement this advice, build a diversified portfolio by selecting stocks from various sectors and industries. Focus on companies with strong fundamentals, such as consistent earnings and solid balance sheets. Diversification helps mitigate risks and provides exposure to different growth opportunities. Graham outlines strategies for enterprising investors who are willing to take on more risk for potentially higher returns. He advises against certain speculative investments, such as new issues or IPOs, or companies with uncertain prospects, and encourages a disciplined approach to selecting undervalued stocks. Enterprising investors should focus on finding value in overlooked or out-of-favor stocks, avoiding the pitfalls of speculative trading. To implement these strategies, if you have a higher risk tolerance, conduct thorough research to identify undervalued stocks. Focus on finding companies with strong fundamentals that the market has overlooked. Avoid chasing fads or speculative ventures without a solid basis for investment. This chapter provides a framework for selecting value stocks. Graham suggests looking for companies with low price-to-earnings ratios, strong financial health, and potential for future growth. He emphasizes the importance of thorough analysis and maintaining a margin of safety in your investments. Enterprising investors should seek out companies that are trading below their intrinsic value and have the potential for significant appreciation. To apply this approach, use financial ratios and metrics to identify undervalued stocks. Look for companies with strong balance sheets, healthy cash flows, and a competitive advantage in their industry. The goal is to find stocks that are priced lower than their true value, offering an opportunity for capital appreciation. Graham discusses the psychological challenges of investing, particularly during market fluctuations. He introduces the concept of Mr. Market, a metaphorical figure who offers to buy or sell stocks at varying prices. Graham advises investors to remain rational and not let emotions dictate their investment decisions. He emphasizes that market fluctuations are normal and should be viewed as opportunities rather than threats. To implement this advice, develop a disciplined investment plan and stick to it, regardless of market volatility. Avoid making impulsive decisions based on fear or greed. Instead, use market fluctuations as opportunities to buy undervalued stocks and enhance your portfolio. Graham evaluates the pros and cons of investing in mutual funds and other investment vehicles. He highlights the importance of selecting funds with low fees, experienced management, and a strong track record. He also emphasizes the benefits of index funds for their simplicity and low costs. Mutual funds and ETFs can provide diversification and professional management for individual investors. To implement this strategy, when choosing mutual funds or ETFs, consider factors such as fees, historical performance, and management quality. Index funds can be a cost-effective option for diversification and long-term growth. These funds offer broad market exposure and are often more cost-effective than actively managed funds. In this chapter, Graham discusses the role of financial advisors and the importance of seeking professional guidance. He advises investors to choose advisors who prioritize their clients' best interests and have a strong ethical foundation. He also emphasizes the importance of maintaining an understanding of your own financial situation. While advisors can provide valuable insights and guidance, it's crucial for investors to stay informed and engaged in their financial planning. To implement this advice, when working with a financial advisor, ensure they have a fiduciary responsibility to act in your best interest. Stay informed about your investments and maintain open communication with your advisor. This approach helps you make informed decisions and stay aligned with your financial goals. Graham introduces the basics of security analysis, focusing on the key financial metrics and indicators that investors should understand. He provides a step-by-step approach to analyzing stocks, including evaluating earnings, assets, liabilities, and growth prospects. Security analysis involves examining a company's financial health and potential for growth to determine its intrinsic value. To implement these techniques, familiarize yourself with fundamental analysis methods to assess a company's financial health. Use tools such as balance sheets, income statements, and cash flow statements to evaluate a company's performance. This approach helps you make informed investment decisions based on data rather than speculation. In this chapter, Graham delves into the importance of understanding per-share earnings and how they can be misleading if not properly analyzed. He cautions against relying solely on earnings per share, EPS, and advises investors to consider other factors such as revenue growth and profit margins. Per-share earnings provide insights into a company's profitability, but they should be analyzed in the context of other financial metrics. To implement this advice when evaluating stocks, look beyond EPS to assess a company's overall financial performance. Consider metrics such as revenue growth, net income, and cash flow. Analyzing these factors provides a more comprehensive view of a company's financial health and growth potential. Graham presents case studies of 4 different companies to illustrate his investment principles in action. He analyzes each company's financials, management, and market position to demonstrate how investors can apply his methods to real-world situations. By comparing these companies, Graham highlights the importance of thorough analysis and the application of value investing principles. To implement this approach, conduct your own case studies by analyzing companies you are interested in investing in. Use Graham's principles to evaluate their financial health and growth potential. By applying these methods, you can make informed investment decisions based on solid research and analysis. For defensive investors, Graham outlines specific criteria for selecting stocks, such as financial strength, dividend history, and earnings stability. He emphasizes the importance of focusing on established companies with a track record of consistent performance. Defensive investors should prioritize safety and stability over high-risk, high-reward opportunities. To apply this strategy, use Graham's criteria to create a checklist for evaluating potential investments. Prioritize companies with strong financials and a history of stability. By focusing on established companies, you can reduce risk and build a solid foundation for your investment portfolio. Graham offers guidance for enterprising investors seeking higher returns through active stock selection. He suggests looking for companies with low price-to-earnings ratios, strong balance sheets, and potential for growth. Enterprising investors should be willing to conduct in-depth research and analysis to identify undervalued opportunities in the market. To implement this approach, use fundamental analysis techniques to identify undervalued stocks. Focus on companies with solid financials, strong management, and growth potential. The goal is to find stocks that are trading below their intrinsic value, offering an opportunity for capital appreciation. In this chapter, Graham explores convertible securities and warrants as alternative investment options. Convertible issues allow investors to convert bonds or preferred shares into common stock, while warrants provide the right to buy shares at a specific price. These instruments can offer attractive opportunities for enterprising investors, but they also come with unique risks. To implement this knowledge, evaluate convertible securities and warrants as part of a diversified investment strategy. Consider the potential benefits and risks of these instruments and how they fit into your overall investment plan. By understanding these options, you can make informed decisions that align with your financial goals. Graham presents 4 case studies to illustrate the application of his investment principles in real-world scenarios. Each case provides valuable insights into the challenges and opportunities faced by investors. By examining these examples, readers can gain a deeper understanding of how to apply value investing strategies to their own investments. To implement these lessons, study Graham's case histories and apply the principles to your own investment analysis. Use these examples as a guide for evaluating potential investments and developing a disciplined approach to stock selection. By learning from these case studies, you can enhance your ability to make informed investment decisions. In this chapter, Graham compares 8 pairs of companies to highlight the importance of thorough analysis and careful selection. By examining these comparisons, investors can learn how to identify strong investment opportunities and avoid potential pitfalls. Graham's analysis emphasizes the importance of evaluating a company's financial health, market position, and growth potential. To apply these lessons, conduct detailed comparisons of companies you are considering investing in. Use Graham's approach to evaluate their financials, management, and market position. By comparing similar companies, you can identify those with the strongest potential for growth and success. Graham discusses the relationship between shareholders and management with a focus on dividend policy. He emphasizes the importance of evaluating a company's dividend history and management's commitment to returning value to shareholders. Dividends can provide a stable source of income for investors and indicate a company's financial health. To implement this advice, consider a company's dividend policy when evaluating potential investments. Look for companies with a history of consistent dividend payments and management teams that prioritize shareholder returns. Dividends can be an important component of a well-rounded investment strategy. In the final chapter, Graham emphasizes the importance of the margin of safety as the central concept of investment. This principle involves investing in assets that are priced below their intrinsic value, providing a cushion against market fluctuations and potential losses. The margin of safety is a key component of value investing and a crucial element of long-term investment success. To implement this concept, focus on identifying investments that offer a margin of safety. Look for stocks that are undervalued by the market and have strong fundamentals. By prioritizing a margin of safety, you can protect your portfolio from potential losses and enhance your long-term returns. Thank you for joining us as we explored The Intelligent Investor by Benjamin Graham. By applying these timeless principles, you can develop a disciplined and successful investment strategy that focuses on long-term growth and financial security. If you want to read the full book, there is a link to it in the description below. If you found this video helpful, please like, comment, and subscribe for more content on personal finance and investing strategies. Share your thoughts and experiences with us in the comments below. See you next time with more money in your pocket.